at sub 3,000. So let's see how it plays out. Let's pull up Berger, Kansai Nerolac. Let's get all of the paint stocks up on the screen. Akzo is not falling too much. Berger is also flat. Most paint stocks actually flat. Perhaps, like Mangalam has been saying, the market had an inkling of this coming all along, so it's not coming as a big surprise. Now Akzo is seeing a little bit of red as the market digests the news. Yeah, a little over 1%. Down on Akzo Nobel. So that's what we have.
So now my sense is that the Akzo Nobel stock would be, in the red all the way until, the deal price is there, and that acts like a floor price for the stock from here on. Yeah. All those who were bidding the stock higher, hoping for a deal and an open offer to come by at prices earlier at which Akzo Nobel was trading or at a premium to what it was trading, have their hopes have been quashed. Absolutely. It is at around 2,700 rupees per share. So those people might be unwinding their positions, but they won't until the 2,700 mark is, holding on. That will become a base price. And from yesterday's high as well, the stock has seen a bit of a knock. Ever since, the story came by that JSW Paints will go ahead and acquire the company. I remember Ashwin saying on the air as well that they valued the promoter's stake at 9,000 crores. As against the 10,000 crores that it was yesterday. So from those levels, the stock has seen a bit of a knock. Still holding.
I know. Actually, I'm a little surprised that the market isn't pricing it, because now you have a price. The asset has been priced at 2,762 rupees, but the market price is still holding higher, which is interesting. We'll keep analyzing the story as we go forward. Let's look at the rest of it then. 50 points higher on the Nifty, so the bulls continue to show up their good form. Let's see what's taking the market higher this morning. There's L&T, 1.5% up. There's Tata Steel. There's State Bank of India. There's Hindalco, NTPC. It's a complete mix of stocks and sectors really out there. Tata Motors is having a decent day. There's Apollo Hospital, Axis Bank. So it's a good mix. Reliance is still contributing. Infosys is contributing on the upside. State Bank of India and L&T. So these are some of the heavy hitters this morning. What is not contributing is HDFC Bank. Pretty, decisive in its down move today, over 1% lower. And then there is Cipla and SBI Life. These are some of the other stocks which are quiet as we speak. So Bank Nifty is playing a little bit of a spoil sport, keeping a check on the Nifty overall. Nigel.
Well, that's right. In terms of stocks on the broader markets, Dixon, that one is getting its mojo back. It's up close to around 4%. Equerris had come out with the note. They have an ad rating on the stock. They remain positive on the stock. They believe there are multiple near-term positive catalysts. And they also say some of those concerns are premature in nature. So that could explain one of the reasons the stock is up close to around 3%. So good up move on that particular name. What else? Metals are doing well as a pack. We had highlighted this earlier this morning as well, that technically, you have the 50 DMA that's moved above the 200 DMA. And the world seems to be in a better place if these tariff tantrums are gradually easing out. At least that is the hope. For the time being, the metal index, which hasn't done anything in the last 1 year, well, that's up close to around 1% or thereabouts. So China remains the problem. We don't know what's going on that front. So that's the other pocket that I'm looking at. A few more names that are moving around. Prime Focus, we don't talk about this name very often. Stock is up more than 10%. So solid up move is what we're seeing on that particular name. Western Carriers, another one that won an order, I think, yesterday. I think today as well, there was some small order win out there. That stock as well is opening up higher. And Mobiwick, yesterday it saw a big recovery from the day's low. Today as well, it's building on to those gains. From the broader markets, Brain-based Solutions has come in for some profit taking. Last few trading sessions, it's been moving like a rocket. Today, it's cooling off a little bit. And just one word on stocks like HDFC Bank. Yesterday, they ended with a flourish. Sometimes you see some of these stocks that do that in the last hour of trade at the last day of a particular series. The next day, just for that day, they realign themselves just to adjust for what they did in the previous trading session. So HDFC Bank, I think the trend is up, but I think it, just readjusting itself. Just one word, guys, with regard to this paint deal. I'll keep an eye out on JSW Cement's IPO. Money is going to be required. The group, I think, could look at fast-tracking those plans, just to comment that I think so.
All right, we will keep an eye out on that itself. Meanwhile, the Nifty Bank, despite the HDFC stock being lower, is contained by its losses, just about 50-60 points. That's because SBI is doing well. Axis Bank is doing well. SBI, of course, aims to raise about 25,000 crore rupees via a QIP. Torrent Pharma is one of the stocks which is up around 3.5% as well. There's a note that is coming from JP Morgan this morning on the stock. They've upgraded the stock. The target price is close to around 3,800 rupees. So that's one of the bigger gainers in the broader markets. Siemens is one which is coming in for some buying as well, up close to around 3%. We continue to see some traction being built on Vodafone Idea. Ever since the comments that have come in from Jyotiraditya Scindia, the stock is up around 12% this week. This morning starts with gains of about 2%. And rail stocks do fairly well this morning as well. So Titagar is up higher in today's trading session. Translate Lighting is the other one. Another stock not regularly spoken of, but a big mover this week is Bajaj Consumer. They announced the appointment of a new MD this Monday, and the stock was locked in upper circuit, a 20% upper circuit on that day itself. Continued to hold on to its momentum, currently higher by about 4% on Bajaj Consumer. It is it's almost 30% higher this week itself for that stock. So good time to bring in Krishna Sangvi, who's the CIO equities at Mahindra Manulife Investment Management. Thanks a lot for joining in. The market looks good. Last week has been good. The global, picture seems to be a little more clearer than what it was, say, about 10 days ago, Krishna. But the big news that came this morning was on the paint sector. So let's start with asking you your views on consumption and the paint sector in particular. It's been a long summer for all these paint companies ever since Birla's announced their foray. There has been a multiple de-rating for a lot of the incumbents as well. And now this morning, there is another deal that has come in. JSW has gone ahead and bought Akzo Nobel. In light of this disruption, what are your views on consumption and paint stocks in particular?
Yeah, no, actually, maybe this disruption, as you mentioned, is perhaps, one good indicator that, Indian consumption story is pretty much intact. Yes, there are new players entering, and, for any segment, when there are new players entering, there can be some sort of a, market share, grab kind of competitive activities which plays out and which is pretty normal. But the big picture is, yes, there are quite a few sectors or subsectors of consumption where new players are looking to enter. And so look at consumption in slightly bigger details. Yeah, what all we need perhaps for consumption is, let's say, more money with consumers. That's partly played out through, tax reliefs in the budget. People are going to have more money as the year progresses, the amount actually goes up. On the other side, we also have a situation where in next 6 months or so, the pay commission announcement is likely. Consumption had a slightly weaker patch, even from a numbers perspective. YOY, the base has been weak. So I think broad picture on consumption, core India, demography, India earning, stroke, tax relief, more money with consumers. I think that's going to play out. So consumption as a broad space, we expect things to improve from now on.
The stock of the morning definitely is Akzo Nobel. What a big recovery that we've seen from the lows, despite the offer being a lot lower than the current market price. Maybe the street believes that the new ownership.
That's the only logic that I can find, Mangalam.
That exactly is the only ownership.
It's a deep-pocketed, serious player that means business and can put more money to work, that can perhaps withstand even a pricing war if one were to come through. And I mean, from Akzo Nobel, who wanted to sell an MNC company, not looking at too much of interest maybe in India, at least in this part of the business. Now you have a serious corporate entity backing it.
I'm not too sure whether it is about the deep pockets of the conglomerate that is backing it, etc. It's more of a relief that okay, the deal is done now, because up until the deal would happen, people would be skeptical of bidding into Akzo Nobel, knowing that at some point someone will go ahead and buy it. So irrespective of who's bought it, and I'm sure there's strong people, whoever buys it is a 9,000, 10,000 crore asset, will not be shallow pocketed, but the ones who buy it, the fact that the deal is over makes people now a little more relieved that okay, this is what the future of Akzo Nobel looks like. The stock has been under pressure. Maybe there is a bet that needs to be taken.
Let's ask Krishna. Krishna, we're not asking you to comment on any individual stock, but we're just trying to find rationale. Typically, when deals are announced in the market pays a lot of attention to the price at which the deal has been done. Here, that price is 16% lower than where the market was after a big correction in paint stocks. And now the market's taking a very favorable view. How would you read into this? What are your thoughts on the paint space?
So I think let's not read too much into the immediate price reaction, just on the deal being announced, because this doesn't really add value, because even the buyer perspective, obviously they've not bought for a single day kind of thing. It's basically a new business opportunity for them. Paint as a sector, as you mentioned earlier, I think consumption play is pretty much, the core story. We have a nice combination of, whatever I say, house durable, the house paints going on, maybe infrastructure is improving. So paint is structurally a good story. competitive intensity can, decide little bit shift of market shares or, margins, profitability, etc. But that does get, captured in market valuations.
Hi, Krishna. Good morning and good to see you. One problem has been the kind of supply of paper. Day-to-day basis, $500 million, $1 billion worth of sale that's coming in. Actually, for one, I'm happy that we're going to be seeing, the earnings season that will take shape in the next week or so, because a lot of these companies will go into silent period. If that's the case, and if liquidity continues the way it is, do you think there's a chance that you'll have the broader markets actually that will outperform?
Yeah, fair thing in the sense that let's look at the supply of papers is continuously on the rise. If the numbers are broadly right, I think in last 6 weeks or so we would have got roughly 1 lakh crore worth of supply, either primary or promoter sale combination. It is a large supply. Luckily, markets are able to absorb, and despite that supply, markets are again making newer highs. So that's possibly telling us the markets are clearly in a bull trend. Maybe global markets are equally supportive. It's not only India. Let's not forget, it's not only India. Almost all major global markets are making newer highs for current calendar year, and India is no exception. So to that extent, yeah, markets are in bull phase. Some of the supply is being absorbed. Two combination, you have a nice free float increase in the market, which somewhere will help rationalize valuation. So in a way, yeah, supply one needs to be slightly worried, because at some stage this supply takes money away from existing stocks. So demand supply dynamics will matter. But yeah, for now, the broad bull market phase is on. Yes.
Okay, got that. So, Krishna, then tell us about your preferred sectors, and definitely mention in a word on defense, because of the last, I think, 6-7 months, this is the one pocket we spent so much time talking about. Stocks have done well. For now, at least, the war issue seems to have receded in the background. But your thoughts?
Yeah. So I think from a sectoral choice, BFSI, comes in as one of the name. We got a nice combination of, regulatory support. Reasonable rate cuts have happened. Money supply is increasing, so liquidity is back in system. So if we add those two, which is the core requirement for a BFSI as a space to do well, so that's one particular space. I think consumption, I did mention earlier, is equally a sweet spot going ahead because of multiple factors which I mentioned. Defense, yeah, it's actually India's core story which has emerged post COVID, when government decided to go for some sort of that self dependency, Atmanirbhar, for India's defense needs. And quite a few Indian companies have shown their ability, or on the way to show their ability to get into export market for defense. So structurally, yes, defense also can be good. Valuations, one can always wait on some stocks for a better opportunity.
Right. And what about, the banks? A lot of people are finding value in financials right now because every other pocket seems to have run its course or fraught with uncertainty where valuations are compelling. They believe that if there is any growth that is likely from here on, banks stand to benefit the most. What are your thoughts there? Do you prefer private banks, public banks, or you look at NBFCs as an option?
Yeah, so the bigger piece is, let's say, lending. So if credit growth is back in system, I'm sure banks and NBFCs both have a participation in growth. From a cost of fund angle, maybe benefits to NBFC may be slightly ahead of benefits to banks, because the way the liability side is structured. But from a very good angle we got is when this rates hike cycle happened in 22-23. We got a nice roadmap of how assets gets repriced for a bank and how liability repricing follows with some lag on of 3, 6, 9 months based on the liability profile of the bank. So my guess is NBFCs can be a near-term beneficiary of a lower rates on their borrowing side, while banks should follow with a 6 to 9 month lag at max. So if I look at FY27, maybe which is possibly a full relevant year for this purpose, I think both banks and NBFCs as a lending combination will have a nice sweet spot of liabilities repricing already having happened, and the credit growth being back in system. So good earning growth for FY27.
All right, Krishna, final question before we let you go. The fear is, towards the end of this year, again, we get into election mode. Bihar will kick it off with, I think, the state elections. How are you positioning with regard to, what are your expectations, both on the fiscal and the monetary front? RBI has given a good booster shot for growth, and they have shown that they are pro-growth. On the fiscal, it seems that, maybe there's limited headroom now, and particularly with these state elections coming about, again, it, keeps sentiment subdued. Your expectations on both these two fronts?
Yeah, so at macro level, from a fiscal policy perspective, the central government has reached a stage where we actually on a fiscal consolidation, nice way to reduce fiscal deficit by, 20, 30, 40 bips based on the yearly, situation. So that roadmap is intact, which is healthy fiscal consolidation, and that should support the broad macro for the country. So that's a good part. I think clearly RBI policy on monetary, accommodative stance which they took, and very nicely, the quick quantum of rate cuts in terms of 100 bips in just 4 months, as well as nice liquidity expansion. It should play out for economy going ahead. Elections, do have on the card in India, but we've seen in elections almost every 6-9 months happening in India, because 29 states, almost everybody goes through a 5-year cycle. So election part, honestly, markets, have taken into their stride over time.
Okay. All right, Krishna, we'll leave it on that note for this morning. Thank you very much for joining in with your perspective on the market. And the market's been actually holding up okay, but there is a little bit of profit taking coming in, and you'd expect that because it's been a good week. We've been already rallying almost 2%, barely 3% off the all-time high. So there's some, hint of caution, some profit taking. Maybe that's not too bad at all. Where is the money coming off? Bajaj Finance, there's Bajaj Finserv, there's SBI Life. Financials, remember, rallied very hard yesterday. So there's a bit of a cool-off. On HDFC Bank, just to add to the point that Nigel made earlier, someone just pointed out this to me a while back. It's also gone ex-dividend today, and the dividend was 22 rupees. So there's that factor playing out as well on HDFC Bank. So that's pretty much where we are with respect to the market. SBI actually is, however, keeping the other end fairly all right. SBI is up 1.5%. It is the Nifty winner at this point in time. So that's how it's playing up. Mid-cap index still in positive territory. Well, the sector that we're now putting the spotlight on is the power space, because there are fairly interesting developments. Torrent Power has received an important go-ahead from the Maharashtra Electricity Regulatory Commission to offer parallel distribution services in Pune, in Nagpur, and in the Mumbai MMR region as well. Do note that this decision marks the first step for the company to operate as an alternative electricity distributor alongside existing discoms. And that's not all. Now we know that Tata Power has, bigger plans for the rest of the state, for all of Maharashtra, and they're looking at getting into parallel power distribution as well. So what does this mean for power generators, distributors, or entire transmission set up in terms of fresh capex? What is the opportunity? Let's discuss this. We have Chanchal Rajora, Group CFO and advisor to the board at Transformers and Rectifiers. And we also have with us Nikhil Nigania, Director and Senior Analyst at Bernstein. Gentlemen, thanks very much for joining in. So this is interesting news. It's a good development. Obviously, it's great for consumers. Choice is always a good thing. Nikhil, let me get your opening thoughts in on this whole setup of being a parallel operator. Let's talk about, say, Mumbai, where Torrent Power wants to get in, where the Adanis are already present, Tata Power is already present. Is the market big enough to make an inroad? And then likewise for the rest of Maharashtra, where Tata Power wants to expand. Your thoughts?
Sure. So in terms of the regions these three players are looking to target, it's not really the part of Mumbai addressed by Tata Power and Adani at present. It's more areas where they compete with the state distribution company, MECDCL. So that is a plan. And if you look at the pockets they are targeting, are pockets where they can see good set of customers, industrial, commercial, and high-paying residential customers. So they are picking and choosing pockets which can be remunerative for them. And the parallel licensing, not the most ideal setup. So while giving options to the customer is what should be the direction, but parallel licensing is leading to a capex uplift. It could have been done in an alternate way where the existing infra could have been used by by these new suppliers as well. But given the Electricity Act, the way it is right now, they have to set up a parallel network, which is going to drive up the capex. in this space. I think the number for Torrent, which we don't cover, although, is 15,000 crores across the three regions over 5 years. And for Adani Energy, it's about 6,000 crores in the greater Mumbai area.
So this is where you're just talking about current capex. So Adani 6,000 crores for Greater Mumbai and about 15,000 crores for Torrent if it gets into these three geographies which it has outlined, right?
Yes.
Any sense on Tata Power if they go into this whole parallel network arena?
So their capex, we won't have a view yet. But again, there are different pockets that they are targeting, not these regions, other parts of Maharashtra.
Correct.
But again, subject to the area that they have to cover, they'll have to lay out the same, transformers, distribution transformers, conductors, cables across cities. So it should be a big capex number there as well.
So we'll just talk about how this is obviously great news for T&D players, and we'll Wayne get the view from transformers and rectifiers as well. But just before that, Nikhil, to complete the point for the companies themselves. Is it going to be lucrative? I mean, at the end of the day, is it going to be a value proposition for shareholders for either Torrent or Tata if they decide to expand on the Discom network and go this way? And what's the sense? Can you give us some ballpark estimates? What is the value this will bring to the table?
See, it's still very early days, and this is not a common practice in India, a parallel licensee. These would be among the few ones. The only legacy one is in Mumbai that we have. So it remains to be seen how they evolve. But in terms of returns, if you think from a capex perspective, let's say a 15,000 crore capex would be about 30% equity funded, on which returns on a regulated basis could be about 15.5-16%. Once the network stabilizes, once you get the customers on board, once you reduce network losses, that's the kind of returns usually distribution companies can make.
And to get to that, return of 15-16%. What would you factor in terms of PPAs, power tariffs, costs to ensure that there's at least that much ROI, at least on the equity component that's going into this funding of the capex?
Correct. Again, so very early, so they'll have to tie up new contracts for buying power from renewable companies, from thermal companies, which sort of for a new player, at least they won't have the old baggage, which less than MECDCL have. They have good contracts, bad contracts, which they have to live with. But the new parallel licensees, they can sign fresh contracts to buy power and where they can optimize. They can buy from related group companies or from other generators, wherever they see the lowest levelized cost of power.
Okay, all right. Nikhil, request you to stay with us. So let's get in Mr. Rajora. Thanks a lot, gentlemen, for joining in. Well, Mr. Rajora, if you could tell us the parallel Discom services approved for players like, say, Tata Power, Torrent Power, what does it do to the overall addressable market for you? Any kind of approximate capex as well that you could look at because of this new addressable opportunity?
Thank you on this, first of all. Let me tell you that the broader prospect of this initiative is not only is going to be benefited for the companies like us, T&D Industries, but it is going to be the bigger service opportunity for the consumers also. And the state is also going to be benefited for this, because the service and quality will going to be improved, as well as the cost of electricity is going to be reduced slightly because there will be competition in that. As far as the capex is concerned, as just now the other gentleman says that we do not know what is going to be the capex infusions are there. But yes, there is going to be a very, very sizable capex when you are going to create a parallel distribution network. And this is basically step is not going to be confined up to a city or a territory, but what I understand, the state government is more focused to reach out to the rural part of the states where the electricity is not reaching. And as says, is thousands of crores of capex is required into that. And probably as just says, the Torrent has come up with 15,000 crores, Adani is coming 6,000. Tata may end up more than this, because traditionally Tata is in Maharashtra since long, and they don't want to lose that areas, right? So this is going to be a bigger game changer, not only for the state, but is going to be for the other part of the country also. That is what I feel.
On that point, just hold on to that thought. The reason why the Akzo Nobel stock is moving higher right now from lows, despite the deal being done at around 2,700 rupees itself, is because there has been an open offer which has been made, and the open offer made by JSW Group is at over 3,400 rupees, 3,417 rupees per share, if I read that correctly. And that explains why the stock has seen a big rally from the lows today itself, up 6%, actually the highest single day gain that we've seen all the way since the company announced that they are looking, the promoter entity announced that they are looking to sell this business itself. The open offer at 3,417 rupees is a lot higher than yesterday's close, and is a lot higher than the price at which the deal happened as well, at 2,700 rupees, which explains the big move that we're seeing. But back to the power discussion, on Torrent Power itself, the question is that while you are looking to grow here, can your existing infra, lead this growth, or you will have to put up some new infra for the same? Chanchal?
They have to put up a new infra, because the existing infra will not be able to sustain this, and if they want to reach out to every corner of the state or the city, they have to put up the new infra.
And how long before do you think this will actually fructify? Because, announcement is one, execution and the actual implementation of this is the other thing here. What are the realistic timelines?
This may take several years. It's not going to be happen overnight. In my view, it will take 5 to 7 years. Because first they have to go to the regulatory approvals, then they have to go for the different capex infrastructure things. They have to put up the setup, and ultimately to reach up to the last digital facilities. And then going to the metering and reaching to the consumers. I don't think it is going to be happened in overnight. I feel that it's going to be happened at least 5 to 7 years.
Gentlemen, all this is happening, and we're having this discussion at such an interesting time, because I want to remind our viewers, and this was actually a very recent story, so I don't know if people missed it. All of this is happening at a time when, for the first time in I don't know how many years, Maharashtra is looking at reducing electricity tariffs. In fact, if I go by the quotes that Mr. Fadnavis, and he has the electricity portfolio in the state, the quotes that he's given, that power tariff rates can drop by as much as 26% over the next 5 years. This is different from otherwise all the discoms coming in asking for a tariff hike in every year. Nikhil, comment on this. I don't know if you caught this news or not, but this is exactly what it is. And I'm quoting the minister. For the first time in Maharashtra's history, electricity tariffs are being reduced, not hiked, starting with a 10% cut in the first year. Tariffs will drop by 26% over the next 5 years in a phased manner. This is from Mr. Fadnavis. So, what do you make of this and all of this capex being put to work that we're discussing at a time when tariffs are going lower? Could that be an issue?
See, the tariff cut spoken about, firstly, it will be different for different segments of customers. So the lower end of customers possibly get a higher cut in tariffs, and industrial and higher usage customers, maybe not so much. The rationale for it, one reason we can foresee is if you look at the last couple of years, coal prices have come down. Spot market, which is exchange power prices, have come down. So from a discom standpoint, input power cost or input cost for them for buying power from different generators has sort of normalized over the last couple of years after the high we saw in FY23. At the same time, many discoms across the country took tariff hikes. So hence, a combination of this, higher tariffs, lower cost, is leading to a lower ACS-ARR gap, or lower gap between cost of supplying power and revenue realized by many discoms in the country. So the number for your reference at the national level fell from 50 paisa to 19 paisa of losses per unit in FY24, and we think it could be similar or a lower number in FY25 as well. So given this factor, that's why.
Let's bring that back to Chanchal. Chanchal, you said everyone is looking to capitalize on this opportunity. The problem is the capacity and the availability of raw materials. Do you think that people will be able to, get that sort of raw material to be able to capitalize on this? Because demand, obviously, no problem. Everyone wants more power. But is there enough supply, enough capacity and availability of raw materials?
The thing is, this raw material is a constraint as of now today. But see that these things are not going to happen overnight. These things are going to take place in almost, say, 5 to 7 years' time. And raw material availability is now slowly easing up. Yes, there are the constraints in some of the raw material aspects, like particularly if you see on the transformer sides, there is a constraint on the high voltage transformers, but distribution transformers are available at this moment. But cabling is the constraint which is now easing up. Metering is available. The raw material things are easing up in this country, and this is going to be a 5 to 7 years chain. So I feel that we will be able to sustain and we'll be able to overcome out of this. That is what I feel into that. And look, reducing the electricity, which is just we were discussing about the electricity charges. We also need to understand that the cost of renewable energies is now going down, and lots of renewable energy is coming up into the country, particularly in states like Maharashtra, Gujarat, Rajasthan, and it requires the consumers. And it is
Yeah.
this is giving a new opportunity to the all the producers, and they're going to be benefited for that. So that
Absolutely. And,
consumers.
no, and I also just want to add here that this power reduction that's been announced in Maharashtra, it is being announced by the state discom, by Mahavitran. So that is where, I mean, that's the whole discussion that what will be the viability. These are parallel networks. I mean, will they operate in the same geography or whether the geographies will be absolutely clearly demarcated? So that's something that we have to see. Nikhil, finally, to round things up, what do you like here? The generators, distribution companies, you can play T&D, you can play the grid. What would you look at from an investment perspective?
No, specifically to this development on the distribution side, we don't have many companies in the coverage in the distribution space. Beneficiaries obviously would be the transformer manufacturers, conductor cable guys from this capex if it happens, and the three utilities which are applying for the license, Torrent, Tata, and Adani. But yeah, within our coverage, we don't have a direct play for this development.
All right, we take that point. Thanks a lot, gentlemen, for joining in and giving us your views on this. Let's see whether people can capitalize on this. All the initial issues are taken care of, and eventually everyone benefits. The customers due to higher power, and at the same time, investors who look at players who will benefit from that itself. But the big news of this morning has been the big deal in the paint space, where JSW Paints has gone ahead and acquired Akzo Nobel. In fact, we had an inkling of that from many months. Why is that? Because Parth Jindal himself had told CNBC-TV18 at the World Economic Forum Summit in January in Davos about the Akzo Nobel India acquisition, their interest in this business so far. Listen into what he had to say, and thereafter we'll get an expert to comment on it.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
All right, so that is, you heard it here on CNBC-TV18, Parth Jindal himself saying that because of the ambitions that they have in the paint space, they are targeting close to around 5,000 crore revenue by FY26. 2,000 crores is what they crossed in the previous financial year, just about broke even on the EBITDA. They have to grow faster, look at inorganic, and Akzo Nobel was the asset on the block and for which they had made an offer as well. The open offer for up to 1.14 crore shares of Akzo Nobel at around 34.18 rupees per share. Gurmeet Chadha now joins in. He's the managing partner and CIO at Complete Circle. Gurmeet, you've been tracking the paint space for a while right now. Asian Paints obviously dented by the aggression shown by Birlas, but now we have major conglomerates who always had an interest in the paint space, but JSW going ahead and buying Akzo Nobel gives them a higher chair at the table. What do you make of this for Akzo Nobel and at the same time the paint industry in general?
Good morning, Nigel. It's going to get very competitive. We recently, and Jindal is an aggressive group. By this acquisition, it's already in top 3, top 4. We saw Birla Opus presentation, a few weeks back, where they spoke about annual capacity of 1,100 million liters per annum. That is just second only to Asian Paints, which is roughly around 1,900 to 2,000 million liters per annum. So, and Jindal will get aggressive. So, may not be great news for Asian Paints from a competitive intensity point of view. But overall, from a sector perspective, it shows you that the prospects are pretty bright. We have seen a series of real estate launches last couple of years. but the decorative side, the home improvement side hasn't done too well, whether it is paints and tiles and home decor and kitchenware, etc. And now as projects complete and the civil work gets done, the home improvement gets into shape. And a lot of the launches have been at the mid-affluent and high-affluent segment in NCR, in Mumbai, in Bangalore. And so the overall demand will pick up, but only from a paint industry point of view, there will be another, competitive pricing. Birla has already reached almost 6.7, 6.8% market share.
6.7, 6.8% market share. It's you suppose it is bad news for Asian Paints, but do you think it is bad news for the sector in general because margins of the sector would be compressed going forward, and at the same time there could be a multiple derating from here on?
See, it's already, some of it is, Mangalam, already in the price. If you see the performance of the share over last couple of years, despite markets doing well, despite crude, being lower. In fact, this entire year, it's been averaging at around $70, $75. The stock hasn't done much. So some of it could be in the price. And maybe it may not reflect immediately. But yes, overall, from a near-term perspective, the industry does well, the volumes go up. But I agree with you, margins could come under pressure. Birla Opus also, when we did dealer check, they were putting up these machines, pretty quickly and at, almost at a very reduced cost. Asian Paints used to be very selective in terms of putting the machine, in terms of color mixing, etc. Birla became very aggressive there. So they obviously have been outspending it. And that also added to the pressure in terms of dealer footprints, etc. So I think it will create more competitive intensity. Good for consumers, may not be that great news for all paint players in general.
So the bottom line is, Gurmeet, I'm warning, will you start buying paint stocks? They have gone through such a long winter, but the heat is still on. Competition will probably come in. I mean, these are serious players. They mean business. The question is, buy paint stocks or still stay away?
I would suggest it would be not a great idea right now because wherever you see competitive intensity going up, we've seen that in cement. We saw that some of the price action in cables and wires also, but a lot of them have come back. So I think there are more opportunities in the home improvement space. You should look for things which are more predictable in a market like this. And market isn't cheap. It isn't that even, look at, for example, Akzo Nobel shares. They haven't not done anything for the last 3 years, but they still trade at 30, 40 times. Asian Paints hasn't done much, let's say, last couple of years. But you're not getting it at 15, 20 multiple. So my suggestion is that Indian markets, that the valuations are rich in a lot of large pockets of the market. So you have to be in pockets where valuations are more reasonable, pricing is more predictable, margins are more predictable. This is not a market where you just simply start playing momentum. And we've seen that in terms of price action over the last couple of months at least. So avoidable in my view. There are better spaces in home improvement. There is, as I said, nothing has happened in tiles. Nothing much has happened in sanitary. Nothing much has happened in kitchen and cookware and appliances. I think there are better opportunities there in my view.
Okay, got it. So play maybe the cooker and the tile and the bathroom fitting folks. Just leave out the paints for the time being. Got that point.
Just one clarification.
Thank you, Gurmeet.
Yeah, just one clarification on the entire paint industry. There are a lot of people when they keep talking about how new real estate supply will aid growth for the paint industry, etc. 80-85% of the paint industry still comes in from repainting as against the new supply. So even if real estate supply increases a fair bit, you don't have as much growth on the paint industry because it's 80-85% which is repayment demand. And even the prices of paints, everyone says, okay, prices of paints going down is good or bad, etc. for the industry. Prices of paints aren't as big a determinant of demand for paint anymore in the country because 30, 40 years ago, you had 20% of the overall cost of painting that was labor. That has increased to about 50-55%. So if paint prices increase by about 10% or 15%, your overall cost of painting increases just by about 4 or 5% because 50-55% of the cost is still the labor.
Correct.
So that is something that we'll have to watch out for.
Absolutely.
Okay.
All right. With that, what we'll do is take a short break, come back on the other side. Amitabh Malhotra of HSBC India and Bhavesh Shah of Equirus join us, Wealth, to discuss the recent frenzy that we've seen in block deals.
Welcome back. Guess what? The dip is getting bought. Well, not too much. The market's flat, but that's the point, that every time there was a red, and there were 3 instances of red so far this morning, it's a different market, it's a different texture, and the approach is to buy the dip. And that's exactly what this morning has been all about, at least so far. Well, the other big headline from the market has been all the block trade activity and the block action. So that's exactly what we're going to focus on. We've seen deals worth almost 21,000 crores in the last 2 weeks alone. And of course, the number is much, much bigger if you start comparing from the start of the year. So to decode the environment, the drivers, the pricing, and all of that, we have with us 2 experts, Amitabh Malhotra, Vice Chairman Investment Banking at HSBC India, and Bhavesh Shah, Managing Director and Head of Investment Banking at Aquarius. Gentlemen, thank you very much for joining in. Amitabh and Bhavesh, good to have you on. I'm sure you folks have been very, very busy for the better part of the last 12 months because Deal Street has perhaps never been thriving as much, right? So let's get your opening thoughts in, Amitabh. The naysayers will always raise the question, is there too much supply coming? Does it indicate that valuations are near a top? But you tell us, which side of the argument are you on?
Look, I think the market is seeing and will continue to see a good amount of activity and support for issuances. There are a bunch of factors that have contributed towards these large set of issuance. As you said, there have been a lot of large blocks that have also happened. There have been recent scale down in geopolitical tension and easing of trade uncertainties. And there are other macro factors like strong GDP growth and recent rate cut that we saw. There have also been significant positive trends in the full year results by corporate India that has further aided the market backdrop. You've seen FIIs increase interest in the Indian market, particularly since April 2025. They were net sellers before that, but you've seen them become net positive buyers. Retail inflows and domestic mutual fund have supported this resurgence. So all of this have led to a reduced market volatility. It has reinforced investor confidence and enabled recovery in deal activity. So I'll summarize that recent IPOs at optimum valuation, strong moats, robust financial and well-funded growth plans offer really a long-term value creation that has received strong interest from local international investors, and we think it will continue to be like that.
Amitabh, just a question, maybe an unfair one, but I'm asking you from the top of your head. The exits have included both Indian promoters paring their stake and maybe raising money to invest elsewhere. But the exits have also included a lot of private equity finally moving out. And that's the nature of private equity, perhaps nothing wrong with that. But can you give us some numbers and some quantum, say in 2025 or maybe the last 12 months, whatever data you've looked at recently, what's been the total value of deals? And roughly speaking, how much would be foreign exits? And then the question, is that a concern?
Look, it's difficult to give you data at hand, but I'll give you some kind of indicators to that. You're right in saying that there have been a mix of both offer for sale and primary fundraise. And at the point being, the market has shown some really good appetite for secondary absorption with the likes of, for example, Hexaware Technologies. It was 100% OFS over $1 billion. And now we are seeing NSDL on the road with 100% OFS. So market is now accepting these stories. This indicates that the market investors have become more mature and resilient in accepting OFS as part of an IPO, as long as the company's fundamentals are strong and pricing is reasonable. And some of these examples that I gave are pretty much an proxy for that. Look, although fresh funding will still play a strong role in growth sectors like renewable, tech and fintech, we believe there will be a slight tilt towards OFS-led IPOs in 2026, particularly because the nature of these situations are where, like you said, private equity, some money to be taken by the promoter of the block to fund their other acquisition. You talked earlier about JSW Paints, obviously looking at acquiring Akzo Nobel, so they've also funded that through that route. So we'll see that happening a lot more.
Okay. All right. Interesting thoughts there. Let me come to Bhavesh as well. Bhavesh, similar sort of questions to you. Your thoughts on the deal buzz that we've seen. And again, the fact that there are so many OFSs. Amitabh is saying it's a sign of maturity of the market. Your thoughts? Is it a concern? Is it not indicative of maybe valuations?
Surabhi, thanks for having me on this on the show. What I can say is what we are witnessing right now is a completely game-changing scenario in the capital markets. It's a very, very positive sign that we're seeing in terms of both the absorption of the stock which is coming into the market, and B, the willingness of the sellers, or the ability for them to sell in the market as well. If you really look at the statistics on the demand side, it's 26,000 crores worth of systematic investment plan, mutual fund equity coming into the markets every month. And that's almost like a $3 billion. And the mutual fund investors, they are always looking for great companies to invest in. We have seen data where companies where mutual funds have invested, the same mutual funds want to invest more and more in them. For every IPO, that happens, there's a huge amount of work that happens by the mutual fund investors and other investors before they raise their hand to kind of invest in the IPO. But the allocations that they get in the IPO is far too little for the amount of work they do and the amount of resources that they have to invest. So it is this block deals which really help them scale up their investments into each of these companies. And we have seen that for every opportunity for them, they just kind of add, as long as the company is doing very well, as long as company has kept its promises of doing what they have done. I call that as a say-do ratio. If the company is doing what they say, they're maintaining a good say-do ratio. And if the say-do ratio for the company is good, the mutual fund investors are putting more and more money. And in fact, block deals are in fact a very good way for investing for the mutual funds, especially. True. Without creating any distortion in the prices. They can buy in bulk. They in fact can get a better deal, negotiated prices.
No, absolutely. And Bhavish, we hear that because when we quiz the mutual fund heads and the mutual fund CIOs, they say exactly that sometimes, you just don't have adequate stock in the market. So at least when there are good blocks, it allows us to participate. By the way, I think this consensus here within us in the studios, we love the concept of the say-do ratio. I think it should become a standard feature in all financial reporting. What is
not just financial reporting? I think everything ever, what you say versus what you do. What a wonderful ratio that is.
What about Mr. Donald Trump's say-do ratio then?
His will be the lowest.
That's a tangent.
Or rather the highest, depending on 2 weeks. Yeah, so his say is a lot more and do is, we don't know.
Shouldn't go there. Okay. I'm bringing the discussion back to investment banking. But Bhavish, you also raised an important point, right? That mutual funds have been, the whole fraternity has been such a strong support, right? They've been buying a lot of the paper that's on offer. But again, I'm playing devil's advocate here. The fact that mutual funds are not getting the kind of flows that they were getting at the peak of the market, and maybe that turns because the market's turning, sentiment is a big thing. But the last 4-5 months so far this year, flows have been coming down, systematically coming down month after month. Could that be a risk? Who will absorb all this supply? And is oversupply a risk for the market? This is something, and I'm not saying this, this is something that CLSA's Vikas Jain told us just earlier this week, that from an overall listed market perspective, the sheer supply of paper could become a concern. Let's take quick thoughts from both of you. Bhavish?
So I personally feel that, we used to have in investment banking something known as a overhang of stock in the market. And we would advise the stakeholders before they went public to see how they can make this as diverse as possible, their shareholding, and as long-term as possible so the incoming investors don't see this as a stock overhang and which can have a potential stock pressure. We are now seeing a complete reversal of that situation, in fact. And again, I go back to the same, if the company is performing well, in fact, the investors want to invest more and more in the same company. So in fact, the stock overhang is now becoming an opportunity for many of the investors to see that I just don't need to hold a small stake in the company. I can eventually hold a larger stake with the kind of money I'm getting through the systematic investment route. I can deploy more and more in the same company. So in fact, the stock overhang, as long as the company is doing what they promised to do, I don't think stock overhang is an issue at all.
Okay, very quickly, Amitabh, your thoughts? Is oversupply a risk?
It's a multi-billion-dollar question, but seeing it from our lens, I think with many companies getting ready and already lining up for public filings on the back of a fairly robust second half 2025, we believe the momentum will continue in looking forward on 2026 as well. And then you talked about both FIIs and in terms of mutual funds. The AUM for domestic asset managers is growing on a monthly basis. And we think they command now a significant space and weightage in participating in many of these issuances. So the point being that with FIIs becoming net buyers and DFIs continuing to kind of increase in their AUM, we think there's going to be significant activity also in the secondary market. And but and there's always a but. This outlook remains subject to overall market condition, regulatory developments, and evolving geopolitical landscapes, because that could influence timing and investor sentiments and create short windows of opportunities. So I will say optimism with a bit of caution.
All right, gentlemen, appreciate you joining in and filling us in with your take. We look forward to revisit this particular point in the couple of weeks or so. Thanks a lot for joining in. Getting back to the markets, though, the Nifty, well, it's more or less flattish. The Nifty Bank is down close to under 100 points. The trend is still up, as we've been mentioning. The 20 DMA has been crossed decisively, but a few stocks doing a thing of their own. Case in point being Dixon Technologies, that is up close to around 4%. Mitesh Thakkar is back with us. Mitesh, what's your take with regard to the markets? We started off well in the green, pull back a little bit. Would you use a dip to buy into the Nifty and Nifty Bank?
I think on the index, maybe not, but I think it's, the index has been moving so slowly, barring the past 2 days, that the trading interest may be slightly on the lower side, though the drift is still on the positive. So I'm positive. I think the index would go to possibly 25,700. But entering now after 2 days kind of a rally may not be the best idea. So avoid the index, but trade with long bias on the stock side. I have a buy on Coal India with a stop at about 392 for targets of 410. And Coforge has given a good breakout today, good continuations signals. So buy here with a stop at 1920 for targets of 2025.
All right, we take that point. Mitesh, thank you so much for that. We'll take a short break. On the other side, Manisha Gupta joins in with all the updates from the commodity space. Stay with us.
Welcome back. Well, let's shift focus to the commodity markets now. We have Manisha joining in. Manisha, it's a happy Friday for equities. You tell us what's up with commodities, considering the dollar is falling so dramatically. What does that imply?
Oh, absolutely. I'm looking at the copper prices because metals, when you look at the month of June, clearly have been outperforming. So while the crude prices are consolidating and gold really hasn't done so much, but it really is metals, and within that as well, it is copper that you have to keep a look on because we've seen overnight gains in copper to the tune of 2.5%. For this week now, we are at 5.5% for copper. And for the month of June, as I said, we're looking at 9% of gains coming in for copper and clearly outperforming 2025 for many of those base metals there with nearly 28% of gains. So copper clearly the next gold is what the street seems to be talking about. That phrase has been coined and we've seen copper kind of live up to that. Well, Iran-Israel ceasefire is one of the factors that has led to some support coming back in case of industrial commodities. And then the markets also are looking at the weakness in US dollar index, which is trading at a 3-year lows. That has been supportive. Take a look at the demand supply numbers as well, and that has been supportive. When you look at the spot prices, they are trading at a $300 premium to the 3-month futures. So that tells you that the demand in the very near term is on the stronger side, and we have seen backwardations go all the way up to 2026 June. So that tells you that there is supply concerns absolutely coming in. The ready available inventories have declined by 80% in 2025 till time. Well, actually, it has been a 60% of a decline from the month of March itself when it comes to inventories. And with the kind of inventories that LME is holding at this point in time is perhaps just good for 1 day of global demand. So there are concerns coming in because of that one. Also, when you look at supply disruption, well, we've seen that also continue into the trade there. There are risks on tariff. You could be looking at tariffs coming in copper. US has been talking about it for some time. And then refined copper shipments to US are at multi-decade highs of around 2 lakh tons. So everywhere that you look, you're looking at very strong copper fundamentals there. I also want to take you through supply disruption concerns coming in from Chile and Congo as well. Well, whether it has been about refined copper, supplemented copper or mining itself, there have been some disruptions coming in. If you look at the consumption in the meanwhile, and that comes in from IEA's data, which tells you that in 2023, while we did see 26.5 million tons of copper demand, by the time it's 2035, the copper global consumption is expected to gain up by almost 32.6 million tons. Much higher, and well, no, we're not looking at supplies increasing in the same way. The consumption for the clean tech is expected to gain much higher. 6.4 million tons in 2023 is expected to be at 11.5 million tons by the time you're in 2035. Well, this demand comes in from EVs, from chips, from transportation, from construction, and of course, energy transition. There's an important statement coming in from BHP as well, which say that the copper mine grade is constantly declining. They also say that where we were at least a couple of decades ago, the grades have continued to decline. The mines also are facing aging challenges. So on the mine side as well, there are concerns coming in. And more interestingly, the University of Southern California says that next 20 years, the kind of copper demand that you would be looking at is the kind of demand that you have seen until now in all of these years. So with those kind of numbers coming in and everybody putting in a very, very bullish tone for copper, the prices have only one way to go, and that's higher.
Okay. Got it. Manisha, thank you very much for that. Well, with that, we have to take a very quick break. Come back on the other side, and it's our special segment, Indianomics. Lata speaks with economist Praveen Krishna of John Hopkins on the likelihood of reciprocal tariffs after the July 9 deadline.
we have been discussing the global financial markets in the context of the run-up to the July 9th deadline for reciprocal tariffs. Financial markets have been relatively calm, with the S&P 500 very close to its all-time highs, and Indian markets as well making gains. I have with me Professor Praveen Krishna, the Distinguished Professor of International Economics at Johns Hopkins University, an important speaker at the NCAER's India Policy Forum, to discuss how he sees both the domestic US economy as well as international economy gliding through this move towards July 9th. Dr. Krishna, thank you very much indeed for joining us.
Pleasure to be on your show.
Well, first up, how scared should we be about July 9th? If India doesn't get into an agreement, our tariffs go up to some 24%. Otherwise, it is 10%. Every country should be equally worried, but do you see it getting put off? Can we be as sanguine as the financial markets are?
Yeah, about July 9, I'd say that there's an extraordinary amount of uncertainty at the moment. From India's perspective, this would be for at least two reasons. One is that negotiations are ongoing. It is at least conceivable that something is achieved before July 9 of sufficient magnitude that satisfies both parties so that the July 9 tariffs are not imposed back. That's on one possibility. The other is that given the broader domestic concerns in the United States, the possibility that tariffs, the imposition of tariffs will lead to inflation, for example, that sort of set of economic considerations leads the US itself, regardless of a particular agreement with India, to extend further this deadline, and maybe to say, listen, July 9 is too early. There have been multiple events that have come in between, the Middle East crisis and India-Pakistan war and so forth, and so let's just push this off for another 60 days or 90 days or whatever it is. The level of variation in terms of what's come out of the White House and the Trump administration in the last few months has been so great that it's really hard to forecast accurately what this would be. So just in terms of what happens by July 9 and whether or not we get the tariffs or not, that would be my reaction to that. In terms of the actual costs of the tariffs, right? So currently, as I understand it, US tariffs are in the range of somewhere between 5 and 7% weighted average on Indian exports. If the July 9 tariffs are imposed, we're talking about maybe a 26%. Let's say it's about a 20% increase of tariffs. That would be on about roughly $85 billion of Indian exports. So 20% of that is $16 billion. One should be very careful, and I see incorrect calculations sometimes about this, that $16 billion is not a cost that's paid by Indians. It's paid by the importing entities for most part. There's some question about whether some of that gets passed on to Indian exporters regardless, because they absorb some of this cost and so on. Let's say you had that on a 50-50 basis. 50% of those additional costs are paid by US importers, 50% are taken on by Indian exporters. In that case, you're talking about 16 billion divided by 2, that's about $8 billion. So that's not a very small number. And at the same time, it's for a country India's size and given our export basket overall, I don't necessarily think that it's a devastating number either.
Okay. Well, most of the manufacturers we speak to say there's no way we can absorb, 25%. They're expecting it to get passed on.
Right.
So what's your sense, therefore, of US inflation? Do you think that Jerome Powell is right? He's not moving in spite of the fairly big positive real rate at in the US now, because there is every chance inflation will rise?
There's every chance that inflation will rise. One of the interesting facts here is that the tariffs, the announcements of the tariffs, or the expectation of tariffs, was already in place by February, March, and of course the April announcement. But having announced the tariffs, they were not actually imposed, right? And so the kinds of price increases that you might have had by now, by May or by June, had the tariffs actually been imposed, we're not seeing, because the tariffs were announced but not imposed. And so now the expectation is that if now they're finally, in fact, imposed by July, that you might start seeing them affecting prices and so on by later on in the summer, by August or September and so on. And that, I imagine, is what Jerome Powell is actually talking about, which is that given that there is this overhang of this issue of tariffs that might impact prices, that it would be a little too early for him to act in terms of reducing interest rates and so on and so forth. So that concern is there. It hasn't been fully realized, in part on top of the fact that these tariffs were announced but not imposed, there's also this issue that there were large inventories that American importers were holding, and so that carried the U.S. economy through for a couple of months. My understanding is that we've kind of come to the end of that. So now if tariffs are actually imposed, you are going to be paying these higher costs on imports from China, everywhere else in the world. And I expect that there would be some implications of that for prices, very naturally. Yeah.
Okay. What is your sense about the dollar? I mean, it's sub 100 for quite some time now, the dollar index, the DXY,
right,
and below 98 as well. Do you think the dollar continues in this downward trajectory? And what is this? What are the factors triggering that?
So all of it, I think, I mean, as far as the dollar and the decline, the small decline up till now that the dollar has experienced, I think all reflects concerns about what the budget is going to be about, right? So if there's a sense that there's going to be...
You mean the big beautiful bill?
The big beautiful bill of Donald Trump. If it's going to lead to budget deficits, large amounts of financing that has to take place through the printing of money, one way or the other, where you're expecting higher levels of inflation, naturally there's going to be an expectation that yields have to be higher to compensate for that. And so this is the reason that you're sort of seeing people moving out of U.S. Treasuries, and that more than anything else has the first order impact on the value of the dollar.
Okay, but what's your sense about U.S. growth itself? I mean, the markets are sanguine, although the Fed, even in its SEP in the last policy,
right,
clearly marked down U.S. GDP. Why are markets so comfortable? Any guesses?
So, I mean, look, on the one hand, you could look at the world as it is, the multiple wars, the trade wars, the wars in the Middle East, and various other things that are going on, and worry tremendously about where the U.S. economy is headed or what the implications of all of these factors are for the U.S. economy, and ask the question, why is this not reflected in the stock market? And that would be a reasonable question to ask. And if you took that position, that stock should have gone down, you would be on solid ground, I think.
Yes.
On the other side of it, there is this expectation that the big, beautiful bill will do enough things for the U.S. economy, at least in the short run, from the standpoint of taxation, from the standpoint of various subsidies.
So tax cuts and higher earnings, higher EPS.
Higher subsidies for varieties of activities that are undertaken in the U.S., corporate activities and so on, that sustain the stock market. There's that expectation as well, that if this bill actually goes through in some form that's reasonably close to what it looks like at the moment, that could be very supportive for corporates, and that keeps stock prices high.
What's your sense about India? The optimistic way we look at it in India is that if the minimum 10% tariff remains, at any rate, China is going to be charged more. Even now, they are being charged more.
Right.
So, an Indian textile maker or an Indian shoemaker, footwear, textiles and footwear,
right,
things that even India does well, will come to India because there is this 20% tariff, percentage point tariff differential. That's huge. That's enough for a company like a Nike or a textile maker to invest in India rather than China, even pull out of China and invest in India. Is that a good hope? Is that a decent argument?
On the one hand, the fact that the tariffs on India are going to potentially be lower than what Bangladesh might face or Vietnam might face or what's actually been imposed on China, it's given some sense of hope to some people that maybe this is an opportunity that we can seize, right? But my sense of this is, look, if these tariffs were frozen in place for the next 2 years or 5 years or 10 years, if investors had this confidence that this is what the tariff regime globally is going to look like, maybe someone who's currently based in Bangladesh or Vietnam is going to say, let's move to India, right? But the chaos is so great at the moment, and the uncertainty is so great at the moment, that what looks like a lower tariff for India relative to Bangladesh might quickly flip if Bangladesh has some sort of deal with the United States or the Vietnamese do, or there's some other change in tariffs, right? And so if you were an investor sitting in Bangladesh or Vietnam at this point, you would really have to take that into account. How long is this tariff differential actually going to last? My sense, therefore, is that investors would probably wait a little bit. They'll probably be well advised to wait for a little bit before taking such decisions, especially in industries where there are large fixed costs associated with production, right? If this is just some trading activity where there isn't a big fixed cost, there's no physical plant that needs to be installed, there's no employees in large scale that need to be employed, maybe moving from one country to another in a kind of a footloose manner following these tariff changes is an easy thing to do, right? But that is not true for many industries and perhaps not true for most industries.
Yeah, and because of this big uncertainty.
Big uncertainty that the tariff advantage might not even exist for that much longer.
So we shouldn't count our chickens too quickly.
Too quickly.
Yes,
too quickly,
but
right.
On that point, let me conclude with what do you think about India? Right. I mean, I don't know how closely you follow the Indian economy. We've had the advantage of good rains, early rains. But there is this global uncertainty that overhangs. We've had some very positive boosts coming. The fisc, taxes were cut. A good 1 trillion has been handed back to taxpayers as well. We've seen massive interest rate cuts as well, 100 basis cut in the last 3-4 months, and then there's going to be a cash reserve ratio cut as well. So interest cost of capital is going down. So how would you bet on India? Are we any closer to 7%, or will we still do worse than last year simply because of the global uncertainty?
I mean, certainly in the medium run, for all of the reasons you mentioned, and a few others in terms of all of our investments in digital infrastructure, physical infrastructure of the country, they're just very obvious, the improvements that you're seeing everywhere. In the medium run, I am very optimistic about India. In the very short run, what's going to happen this year, what's going to happen 12 months out and so on, it's a little harder to say. Given the range of geopolitical uncertainties, given the range of economic uncertainties, even something as simple as crude oil prices, right? A week ago, it would be completely understandable if someone had forecast a very large increase in oil prices, and it actually hasn't been realized. You haven't seen these increases in oil prices. So if that had actually happened, that would have been bad for India. The fact that it hasn't happened is good for India. These uncertainties are still very large enough that it's hard to say what the coming few months and maybe the year out is going to look like. I feel reasonably good about the Indian economy, but I think I should say I feel more strongly optimistic about the medium run than what's going to happen in the coming few months because of all of the factors we've just discussed.
Okay, well, we'll keep our fingers crossed since a very big geopolitical tension did not push up crude prices. Maybe we are only overestimating our problems and we will still get by with higher rate of growth. Thank you very much, Dr. Krishna, for joining us on Indianomics. That's it on this edition of Indianomics. More news and updates follow.